In this video, traders, I want to talk about what is spread betting. Stay tuned. Hey traders, warm welcome to you. Alright, so you've hit this video because you want to find out quickly what is spread betting. So I want to explain that to you. My name is Mark Holston. I've been trading for 22 plus years. Spread betting was really the first thing that I got involved with. I want to explain to you how it all works and why maybe you should consider this over buying shares. Now maybe you bought shares already, right? And you buy shares and you pay stamp duty on shares. If you've got £10,000, you buy £10,000 worth of shares, you pay stamp duty on those shares. When you sell those shares, you most likely get capital gains tax. There are some reliefs and allowances, etc., but that's ultimately how it's wrapped up. One of the advantages with spread betting, and I'm kind of jumping ahead here, but I think these are the main advantages, are for the majority of people, there is no capital gains tax to pay. It is classed as a bet. It's wrapped up as a bet. And so for all intents and purposes, it's seen as gambling in the eyes of the revenue, and gambling winnings are not subject to capital gains tax. Speak to your accountant, blah, 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 all the other disclaimer stuff. But that's generally why it's so popular in the UK. If you're in Europe, if you're in US, spread betting is not available to you, unfortunately. UK is a very UK-centered and focused product. Okay, the other thing was I mentioned trading on margin. I didn't mention margin, but I mentioned if you had £10,000, you wanted to buy £10,000 worth of shares, that's all you could buy. Now, if you are spread betting, you can make that £10,000 go further by trading on what's called margin or leverage. In other words, depending on the instrument that you're trading, the broker will say to you, hey, you've got £10,000 on account, we will let you buy up to £100,000 worth of this product, for example. You still have to pay the difference if you lose, but we'll give you the difference if you win. So you get to control perhaps 10 times as much capital as you would do if you were buying a normal share. Now that varies from instrument to instrument, and leverage is adjusted also depending on the broker and the regulation, all this type of stuff. But that, for example purposes, that's exactly what you could do. So of course, if you bought £100,000 worth of something using your £10,000 that you've got on account as margin, if that went up by 10%, you would have doubled your margin. Your 10,000 would now be worth 20,000 because that £100,000 position has gone up to 110,000. 10% increase, that £10,000 is your profit. So you effectively doubled your stake, if you like. Well, if you just bought £10,000 worth of it and it gone up, it would only go up by £1,000. You get the idea. But that works the other way as well. If that price goes down by 10%, you lose everything. So it's a double-edged sword. And I've done a video where I talk specifically about leverage and margin, the usages and stuff. One thing to point out is that if you are trading on margin, you will be charged a small holding fee or borrowing fee overnight. So this product, spread betting, is really only suitable for short-term traders. If you're a day trader, you're not going to get charged any of those holding fees, overnight fees. If you're a swing trader, you're holding for kind of multiple days, maybe multiple weeks. Yes, the charge is small, but if you're kind of got this shorter term view and opinion on stuff, then you kind of weigh up and say, hey, you know what, I get this exposure, it costs me a little bit overnight to hold it, is it worth it? And you can work out the commercials for yourself. Okay, so that's that. Let's talk about some of the intricacies of spread betting, why you might use it. So spread betting, like I said, is really a tool for active traders, day traders, in other words, people who buy and sell intraday and close out and have no positions overnight and look to make a profit from kind of short-term oscillations in various different instruments. Swing traders, they're kind of categorized as people who are holding for kind of 1 day, 3 days, multiple weeks. That's really who the product is aimed for. And one thing you can do with a spread bet is you can go long and short. So long is basically, as you would understand buying to be, you buy, if the price goes up, you make money, if the price goes down, you lose money. We'll talk about some of the intricacies of how that's framed in a spread bet in a moment. On the short side, you can profit from a falling market. So if you thought that, oh, I think the FTSE's too high, I think over the next kind of couple of weeks we might see it kind of easing off a little bit, and I want to speculate on that, I want to position for that, I want to make money if that thesis is correct, you could take a short bet, short position, and then if the FTSE did roll over and it started to go lower and you closed that bet at a lower price that you opened it at, then you would make money. If the FTSE continued higher though, you would lose money. So, you know, you can use your judgment and skill to decide, hey, do I think this is going high? Do I think this is going lower? And how do I want to position for that? And there are risk management tools in place. Stop loss orders automatically take other position when the maximum loss is reached, so you don't get any more loss than you want. You've got take profit orders. If you've got a specific price target for something, you can have that. These are all native to many brokers, and you can check out our broker channel sponsor in the description below if you're kind of looking for someone to maybe do some business with. So that's long, that's short. So how is it framed? So traditionally you kind of might buy shares, you might buy this, you might buy that. Now a spread bet is wrapped up, like I say, it's a bet, it's wrapped up as a bet, even though a lot of the platforms are very similar for share trading, CFD trading and spread betting. It's wrapped up as a bet, and it's kind of categorized like this. The ticket is basically saying, hey, how many pounds per point do you want to risk? And that ultimately means that for each increment move in the price. So let's use the FTSE example. There's different kind of ways of looking at it. Like if you're trading a currency pair, if you're trading crude oil, trading gold, then the decimal point is very interesting. Interesting is not the right word. Interesting, not really the right word. It's important. It's probably a better word, because that's going to determine what is classed as a point for a spread bet. But if we use the FTSE, we'll say a point is just a whole point move. So in other words, a point would be, if the FTSE is priced at 7,200.5, 1 point would be not the tenth but the whole. So 7,201 would be 1 point, 7,202, 2 points, 3, 4, 5, etc. That's the same for the Dow. Crude oil slightly different. I'm not going into all the intricacies, don't worry, but slightly different. Crude oil, you know, it would be maybe the hundredth, so it would be $100.12, and it would be the 2 that would be the point. So if that went to 1.3, I'm trying to remember what I actually said there, an example, 1.3, 1.4, 1.5, that would be increment. But you can work it out, and by the way, you know, make sure you open a demo account to play around to understand how spread betting works. Let's go back to the main concept. So you decide on a pound per point position you want to take, and do you want to go, like I say, long, or do you want to go short? Do you want to buy? Do you want to sell? If you're opening a fresh position and you think the FTSE is going higher, let's say it's the chart and it's chugging along, it's sitting at 7,205, you would get a ticket that looked something like this, and it would say, hey, here's the FTSE. And as a side note, by the way, spread betting companies and CFD companies can't call the indices by their correct name. They can't call it the FTSE 100 because actually, technically speaking, it's a synthetic product. You're not trading directly the FTSE 100. The spread betting companies are making a synthetic product where for all intents and purposes, you're trading the FTSE. It's a side note, it's worth mentioning. It doesn't affect anything at all, but if you're kind of going, why is it called that? That's why it is, and I've done a whole video on that topic actually in itself. But forget about for now. You want to speculate on the price of the FTSE going higher, and you want to make money if it does, and you're prepared to lose money if it doesn't. Fine, you've got to accept the risk when you're trading. So you'd have a ticket like this. It would say, hey, 7,201 to buy, 7,200 to sell. The difference between the two is what's known as the spread. And this is how brokers make their money. Okay, if you imagine you had 1,000 people who wanted to buy, 1,000 people who wanted to sell, then they make the spread in between on all those aggregate positions. So that's basically how their money, and the overnight holding charge and all different instruments that they offer. So the tighter the spread, the better. These days, most spreads are reasonably tight for the main instruments, and they kind of vary for some of the thinner instruments and maybe stocks if you're looking to trade those. So there's your spread. So in other words, if you went in now and you traded, what, say £10 per point, and you bought it and sold it straight away, it would cost you £10 to make that transaction. Right? If nothing happened, you bought it, you sold it, the spread is your cost, it will cost you £10. So a nice tight spread is what you want. So if you bought it for £10 a point now, 7,201, what happens is this. As the price goes higher, you make £10 for every point it goes higher. So if you can imagine, you bought this at 7,201, now the FTSE, let's use a purple, now the FTSE, you're right, and the FTSE goes up, and now it comes to 7,000, let's say 7,210, say, okay? So we're trying to work out a reasonable order of magnitude of price. FTSE goes to 50,000. Yeah, of course it does. 7,210, imagine, little 5-minute trade, say, moves up. You're like, okay, I bought it at 7,201, and now my ticket might say 7,210 to 7,211. Imagine this was 7,209.5. So imagine you could sell it now at 7,210. You would have made 9 points profit. Okay, because it's gone up by 9 points. So that's the difference between your buy price and your sell price. That then is multiplied by your position size. And what do we say we were going to do? £10 per point. Okay, so in that instance, you'd have made £90 because your position size was I wanted to trade £10 per point. It's gone up by 9 points. You've closed the trade. You've sold it 9 points higher. That's what you've made. It was 100 points higher. It's going to be £1,000. If it was 10 points lower, you could have lost £100. So if the difference between the buy price and the sell price is lower, so in other words, you've lost money, it's gone lower, you are going to lose £10 for every point. And you can adjust that position size to suit. £10, £20, £2, £1, 50p. Some brokers allow you to do 10 pence. You can literally adjust the position size to accommodate your risk tolerance, how much you've got on account. And they will, obviously they'll restrict you depending on how much you've got in your account. You can only manage a certain size position based on the regulations and the leverage and margin available, etc. So that's really how it works. And one thing to note is that the more right you are, the more money you make, and the more wrong you are, the more you lose. This isn't something that is a fixed odds game. It's not like going out there and saying, hey, I think Man United are going to win on Saturday and I'm betting 50 quid on the win. They do or they don't, and you make money, you don't make money. The thing is with spread betting is the further the price goes in your favor, the more money you make. So in theory, you know, you can, I'd say unlimited because that sounds a little bit hypey, but in reality, you know, the price can go as high as it wants. And if you're long and you're making money, you'll make money the further and further and further and further and further and further it goes. So that's kind of one of the advantages with it. If you think, hey, it's going to really rally, it does really rally, it does a 300, 400, 500 point rally, and you're long £10 a point, you're going to make some good money. But there's also the chance of it going the other way as well, which is why we use and talk about risk management loads and using some of these tools and technologies to manage the risk and make sure you don't risk and lose more than you kind of wanted to. I wanted to talk a little bit about, margin, talk long and short, expiry. So they can become, you can get a little bit overwhelmed when you look at you go open your broker account, you look and you see all these markets, like so much stuff to trade, and they've got these expiry dates to them. I would say the shortcut is to just go to the cash product because they have got different products available. So FTSE 100, they'll say, hey, got a June expiry, we've got a July expiry, September expiry, whatever it may be. That just means that you pay a bit more spread initially and it will automatically close the position at that date. So if you have something 3 months out and you buy it, you'll pay more spread. But if you haven't got a rollover tick to add more complexity to this, it will close the position automatically at the midpoint. So you kind of save a bit because you're not paying those overnight charges. I would just avoid that. I would just say, hey, focus on the cash instrument because the cash is what they call, most of them call it the cash. It's just adjusted each day. You pay a little bit of a holding charge. The spread is very, very tight. If you find out that you have a requirement, you want to save something, you think it's worth looking at some of these different expiries, do that. But I wouldn't add the complication. As my just opinion on things, I'd say always recommend just trading the cash product, especially if you're a very, very short-term trader. The more short-term you are, the more benefit you're going to get from trading the cash product. Talk about margin, retail and pro. If you go into the broker, you'll see if you can get categorized as a retail trader or professional trader. Most people are going to be categorized as a retail trader. That gives you negative balance protection, which means that in the UK at the moment, at the time of doing this video, everything could change, by the way, your balance can't go below zero. So if you get caught out on something, market moves massively, you haven't got a stop loss in, you're never going to lose more than you've got in your account. That never used to be the case. You used to be on the hook for this stuff. So that's quite a nice thing that's available if you're a retail trader. The margin is reduced a little bit compared to the professionals, and there's some other things like some products you can't trade. If you qualify as a professional, this is a separate topic completely, but you do get some perks in the case of increased margin, access to different products, but you do lose some of the protections that come with being a retail trader. Okay, final thing is ownership. You are betting on direction of an instrument here. You don't own the instrument. So if you wanted to buy Marks and Spencer's and you wanted to vote, then if you were buying the voting shares, you would get a kind of say. You don't get this with this. You do get a dividend. You do get a kind of a chunk of a dividend. You get a percentage of it. The broker keeps a little bit kind of for the administration, but you do get kind of a bit of a dividend payout with it if you hold it during the ex-dividend date. So there is that, but you don't actually own the stock. You are betting on the direction, and the other side of the bet or the counterparty is your broker. I think that's it. I hope that's helped. What is spread betting? All I can say is if you are going to spread bet, please understand the risks, look at the risks. It can be very lucrative. It also can be kind of risky as well. So appreciate the risks, look at all the disclaimers, don't take things for granted, do your homework, do some research, come up with a trading plan and subscribe to this channel. See you next one, take care, bye bye.